Dolph de Roos was born in New Zealand, speaks 6 languages, and is a highly successful real estate investor, both inside and outside the United States. Dolph has written 5 real estate books, including the New York Times bestseller Real Estate Riches. He's also introduced a powerful software program for analyzing and managing investment properties. In the late 1990s, he launched his own property investment company, and today its holdings range from high-rise apartment buildings to high-end vineyards. Dolph is frequently asked to address investors' conferences and to make radio and TV appearances. Nevertheless, his primary focus remains to this day the real-world business of real estate investment. Dolph de Roos, we've invited you to contribute the segment on real estate investment to the Wealth Builders Blueprint because of your experience as a real estate investor and as a teacher to thousands of others worldwide. Tell us first, please, a little bit about your experience with real estate as a practitioner and as a teacher.
Well, John, I had an unusual introduction to real estate. I came from a family who believed that to do well in life, to do well financially in life, you have to study hard and get a degree. So it was without thinking when I finished high school that I went to university. And it was during my very first week at university that I looked around me at the people with the degrees, the professors, the tutors, the lecturers, and they seemed anything but rich. So I thought there's something wrong with this theory that degrees equates to wealth. So I set about finding out what is it that the rich have in common. I thought if I could identify 30 or 40 things that the rich have in common, and if furthermore I could emulate those things, then I too could be rich. And at the time it seemed like a perfectly reasonable theory. So I started the study not realizing it would take more than 9 months because, John, I could hardly find anything that the rich had in common. It certainly wasn't age. By all accounts, Bill Gates was a young man when he made his first billion. It wasn't gender. It wasn't religion. It wasn't whether you were born into a rich family or not. It wasn't whether you were an immigrant family or not. And it certainly had nothing to do with education. So at the end of my 9-month study to find out what the rich have in common, I could only find 2 things that they did have in common. And one is that almost without exception, the rich either made their money or held their wealth in real estate. And that is why at the tender age of 17, I decided to get into real estate. To this day, I've never had a job, and I've just been in real estate ever since.
What is it about real estate that you see as so specially powerful and valuable?
John, I believe that real estate is the only investment vehicle that in fact will give you true passive income, and I've got some very strong views on that. But before getting into those, I am astounded that something like 93% of Americans, when they invest, or when they think they're investing, they invest in the stock market. And I think the stock market is almost the very opposite of what real estate offers in terms of benefits. And let me give you just some brief examples. If you wanted to invest in either the stock market or real estate, and let's say you've got a lump of money, it doesn't matter how much, it could be $1,000, it could be $1 million, but let's talk about $100,000. When you invest $100,000 in the stock market, you can buy exactly $100,000 of stock. That's the way it works. Whereas that same $100,000 when invested in the real estate market can easily buy you $1 million of real estate. Now, to be sure, you need a $900,000 mortgage to do so. And I know some listeners might be saying, well, hang on a minute, with a $900,000 mortgage, how am I going to pay the interest? Well, the answer is, of course, you own an asset worth $1 million that is generating rental income. So the point is you've got leverage with real estate in a manner that you don't get leverage with any other investment. To put it another way, if you went to any bank manager anywhere on this planet and said, Mr. Bank Manager, I really believe that gold is about to go up in value. My neighbor believes in platinum and silver, and my auntie is a stamp collector, and my friends collect baseball cards, and I think I should get some antiques and paintings. Will you please lend me some money so that I can invest in these things? He will laugh you out of his office. Whereas anywhere in the world you can go to a bank and say, I want to buy some real estate, will you lend me some money? Not only will they say yes, they will be falling over themselves to give you that money. In fact, there are billboards, there are newspaper ads, radio ads, TV ads saying, thinking of buying real estate or thinking of refinancing? Come see us first. We'll give you the best deal. We have mobile mortgage managers. We will visit you at a time and place to suit you. They want to lend you money. So you've got leverage. The effect of that, of course, is that if everything goes up by 10%, Your stock portfolio of 100,000 would have gone from 100,000 to 110. You've made 10%. Whereas your real estate would have gone from 1 million to 1.1 million, and you've made 100% on your investment. Secondly, when you spend $100,000 buying stock, how many dollars worth do you have? What's the value of that portfolio? And the answer is it's worth exactly 100,000. We'll ignore commissions for a moment. Because the stock market is very efficient. It doesn't matter whether you're in Los Angeles, New York, in Guam, Peru, Helsinki, wherever. If you want to buy a particular stock, you will pay the same price as anyone else. Compare that with real estate. You've spent your $100,000 cash buying a property for a contract price of $1 million using a $900,000 mortgage. The day you buy that property, what is it worth? And a lot of people say, well, it must be worth $1 million. And indeed it could be. However, is it not possible that some fast-talking seller talked you into paying too much for it and it's only worth $650,000? And the answer is yes, of course. It happens all the time. But by the same token, is it not possible that that property for which you just paid $1 million is worth $1.5 million? And the answer again is yes. That happens all the time. There are 101 reasons why people will sell a property at below its true value. To name just a few: divorce, or being too stingy to engage the services of an appraiser. They're arrogant. They think, I know what this property's worth. Why should I pay someone $800 to tell me? And yet they don't really know what it's worth. Or they're in a...
Well, in these examples, which are certainly very powerful, maybe by chance you chose a figure of $100,000, is the implication that I have to be somewhat wealthy in order to create wealth through real estate?
No, not at all. That is one of the biggest fallacies, and it comes back to that first point. You've got leverage with real estate. In other words, you do not need to come up with all of the purchase price. Now, you might think, well, if I have to come up with even 10% to buy that $1 million building, I have to come up with 100,000. That's 10%. And the answer is that is one possible way of acquiring that property. But there are so many mechanisms as to how you can acquire property. There is, for instance, nothing to stop you getting a seller carryback or vendor finance. It doesn't matter what you call it, but that's where the seller leaves a certain amount of money in. Now, if he agrees to leave 10% in on a seller carryback and you get a 90% mortgage from the bank, you're 100% financed. In fact, if you can get the seller to leave 20% in and you get an 85% mortgage from the bank, you're 5% ahead. And by the way, there is nothing illegal about that. There is not a law in the world that says you cannot do that.
Let's think about the time involved. It sounds as if real estate investment, though very profitable, is like a full-time job. I'd have to give up my day job in order to be able to do this. Tell me about the time required.
Firstly, you do not need to work at full time. I know many people that I've met personally because they've attended events or whatever, who've just put in 3 or 4 hours each weekend. And then after a year, suddenly they find that they own 2 or 3 properties. Now, they mightn't be multi-million-dollar properties, but even if you own a couple of $100,000 properties for your 3 or 4 hours per weekend, and they go up by 5% a year, that's $300,000. At 5%, there's $15,000. There are only 8,760 hours in a year. That's $2 an hour for every hour that you're awake or asleep or eating or reading a book or whatever.
So, Dolph, we've been talking about the advantages of real estate investment. What could be an action step for this topic?
A fun action step would be to interview your parents, if you're blessed enough to still have them around, or other relatives, and figure out how did they make the bulk of their wealth. In most cases, people will find out that even though they might have bought a classic car thinking it would go up in value dramatically, or Uncle Tom suggested you start a stamp collection because one day it's going to be worth a lot of money, for most people, their single biggest asset is their home, and they will lament, if only we'd bought 2. When you interview enough people to find out about their net worth, how they made it, when they retired, what was their biggest asset, for most people, since it is real estate, when you do that often enough, you will suddenly say, hey, I've got to get in on this bandwagon, except I don't want to end up with 1. I want to end up with 10 or even 100.
Well, we've described this product, the Wealth Builder's Blueprint, in terms of the first 90 days. And can we just, in a very general sense, think about what is a realistic goal to achieve in the first 3 months of the adventure in real estate investment? There's clearly a tremendous amount to learn and a lot to do. What do you feel is realistically possible as a starting point here?
All right, well, what I'd like to suggest is that people within 90 days do something which is so crucial to acquiring real estate that if you do not do this, you will never acquire real estate anyway. And that is, people forget to realize that in order to buy a piece of real estate, you actually have to submit an offer. So I'm suggesting that within 90 days, we teach people all they need to know to submit an offer with confidence. Now, I'm not just talking about writing up an offer because the 90-day limit is coming up, but having the tools and the means to know and discern what is a good property, which is a property that you would like to own that will be lucrative for you to own, and then what do you need to do to analyze it? And once you've analyzed it, what do you need to do to write up a contract to submit an offer? If we can get people to that stage, the rest will flow naturally, because once you're at that stage and you know how to submit the offer, there will be no stopping you.
So we've made the decision to embark on real estate investing. What's an action step that's going to give us some confidence that we've made a start even before we've actually started buying properties?
One of the smartest things you can do, John, is to go and join your local real estate investors association. They're called different things in different jurisdictions, but it's basically a group of like-minded people, most of whom are active investors, and just by meeting with them and talking with them, you can discuss the relative merits of residential, commercial, industrial, hospitality, and specialist real estate.
Is it your experience in those kind of organizations that people exchange information fairly freely?
Oh, very freely. Look, I was in the scientific community, and there was this notion that you had to publish or perish, so everyone was protective of what they were doing. In real estate, everyone wants to share it. They've come across a method or a methodology. They can't wait to let others know about it. It is a very energetic environment.
Sounds good. So could you tell us a little bit about the different types of real estate investment? There are so many books out there are so many seminars, and one hears about different ways of creating wealth through real estate. We hear about flipping properties, which I understand is when you buy one and you fix it up and then you sell it again quickly. And there are other techniques which some of us will know about, some of us won't. Can you orientate us a little bit within this field of the different kinds of real estate activity?
Well, sure, there are many different ways of working the real estate market. And John, no one is better than the other. They all have their advantages and their disadvantages. You mentioned flipping, and you're absolutely right. That's where you buy something, usually in need of some tender loving care, as they call it. You spend a bit of money fixing it, and then you sell it for a higher price, and you make a profit. You can do things which are called wraps, which is where you effectively on-sell the property, but make some money on the difference between the mortgage that you're committed to paying and effectively the mortgage you're collecting from the buyer. There are other mechanisms of working property. You can be a developer, for instance, or you can just sit on land and speculate on land. They are all related to real estate, and in that sense, they're all valid real estate transactions. But what I like is the name of this program is Money While You Sleep. And I love the concept that when I wake up in the morning, I'm worth more than when I went to bed the night before, even though I was oblivious to the world around me in the 8 or so hours that I was asleep. And to achieve that, you cannot really do it with flipping properties. Because when you flip, if you take a 3-month vacation and stop doing your flipping work, then you will not have any income. Whereas when you are a pure investor, when you buy real estate to own it for the long run and you collect the rents from tenants and you see the value of that property go up, when you're a pure investor, that is when you will actually make money while you are asleep. So of all those different categories, I have a personal preference for investing in real estate that you intend to hold for the long term.
So let's turn our attention now to finding properties. We've talked a little bit about the different kinds of real estate activity. There are also different kinds of property. There's residential, there's commercial property, there's single-family homes, there's apartments. Guide us through those kind of choices.
Well, John, most people, when they start off investing, they naturally turn to residential property. And the biggest factor, the biggest reason for that is simply that, with very few exceptions, all of us have lived in a house at some stage. We know what a house entails. We know what might be missing in a house. We know the things that if they were absent, we would say, hang on, there's something wrong here. So we don't always know what is entailed in a commercial or another kind of real estate other than residential. So I think it's very natural that people should start in residential. Now, when we talk about residential property, which I define as any property where people have a residence of one form or another, that can include things like duplexes or quads or eightplexes or even 50 or 60 plexes, and they're called apartment buildings. And there are relative merits of single freestanding family homes versus apartment buildings. I don't think anyone could or should be an expert in all of these. Usually what happens is people find a niche. They find an area where they're comfortable, and when they work that niche a little bit, they also gain experience, so they get better and better at it, so they gravitate more and more towards that area, which is perfectly fine.
We've been discussing the different types of real estate and real estate investment. What could be an action step here?
Well, get out a sheet of paper and start to write down what your criteria are. What are you looking for? Narrow the field. Remember, there are so many different kinds and classes of real estate that you can't look at everything. You might get excited and swayed from one thing to the next. Oh, I want to get into trailer parks. Or, oh, I think I want to get into strip malls. Or, no, I want to get into office buildings. And you'll be jumping around and you'll never do a deal. So get out a piece of paper and start writing down what you want to focus on. It might be residential, no more than 8 years old. You might have a reason why you want no fewer than 3 but no more than 5 bedrooms. Whatever those criteria are, specify them and then type it up on a sheet, or usually these days, print it out. And when you go and visit your real estate agents, you'll be able to show them your criteria. The clearer you are as to what it is you're after, the easier it is for them to show you deals that meet those criteria.
So let's imagine that I've made a choice. I'm going to start with residential because it's what I'm familiar with. And in fact, I'm familiar with single-family homes. That's what I live in. So I'm going to begin my adventure by looking for single-family homes as investment properties. How do I conduct that search?
One way is to go through the newspapers. In most cities, Wednesdays and Saturdays are the primary real estate days. It does vary sometimes around the country. But go through all the listings, read them, start to get familiar with the terminology. I like looking for keywords that tip me off that the seller is very motivated. And it might be something like owner moving overseas, or new job leaving town this month, or estate sale, or as we mentioned before, desperate sellers, highest offer accepted this weekend. Any keywords like that could tip you off that these people are quite motivated. So certainly go through the newspapers. Build up a repertoire of real estate agents that you relate with regularly. So you might go and visit some real estate firms, find some agents that you are comfortable with, and say, look, I'm looking for this specific kind of property. Here are my criteria. The internet now, of course, is such a useful tool for finding properties. A few years ago it was still in a nascent stage, but now you can go to any of literally thousands of sites and do specific searches. You can search by zip code, you can search by city, you can search by number of bedrooms. In fact, all these criteria can be meshed so that they have to meet all those criteria for it to pop out and show you what it's come up with. In fact, when one is out looking at real estate, I always have this rule. I call it the 110-3-1 rule. One should look at 100 properties in order to find 10 that you might want to put offers in on. And when you put offers in on 10 properties, that doesn't mean that you'll have 10 offers accepted. In fact, if you did have 10 offers accepted, it's a sign that you're offering too much. You should come down a bit in price. So of the 10 offers that you submitted, maybe only 3 get accepted. And you still haven't acquired 3 properties yet because we now have to arrange financing. And maybe only 1 gets financed. So we've looked at 100 properties to acquire 1.
So Dolph, this rule, the 110-3-1 rule, really gives us a context for the task of searching for properties. Tell me an action step that's appropriate for looking for properties.
Well, every Saturday, pick up the paper and go through the real estate for sale section. Or if your local newspaper has it, investment properties for sale. Go through, circle any that catch your eye and phone them. You might have to make 30 or 40 phone calls and eliminate 90% of them, but you might end up with a handful that are worthy of further analysis. Make sure you visit one real estate firm every week to see if there's an agent there who might be able to hand you great deals. Pick up at least one realty magazine. That's a magazine with little color photos and descriptions. And spend at least 1 hour on the internet ferreting around looking at properties. You will be surprised what you come up with.
course, we aren't talking about buying property to rent. Therefore, it would seem we need to know what the rental market is like when we're looking at property. We don't want to buy something where nobody's renting.
Right.
How do we find that out?
Well, the hope is that the real estate agent you're dealing with will be able to give you an honest evaluation. But of course, consciously or subconsciously, they've got a vested interest in selling you the property. So they may be tempted to stretch the truth a bit as to what the monthly rentals are in a particular region. The safest way of finding out what the rentals truly are is to phone a property management company and either say, look, I own a 3-bedroom, 2-bathroom home on such and such a street, or to say I'm considering buying one there. If I were to give it to you to manage, realistically, what are the rentals that you could achieve? Now, depending on how comfortable you feel with the answer you get, you might have to phone another one, and instead of saying, I'm looking at placing a property with you for management, you say, look, I'm looking at renting a 3-bedroom, 2-bathroom house. What's that going to cost me? Because then they're going to give you the true figure.
So we've looked at a large number of properties, maybe online, maybe in the newspaper, maybe we've got this information faxed to us from the real estate agent. What happens next? Help us through this.
Well, now we have to start to discern. We have to start to figure out, is this a good deal or not? And the biggest mistake people make is they fall in love with a property. They think it looks cute, or even worse, the neighbor's dog is cute or something like that. What you've got to do is look at the numbers, because at the end of the day, all that counts is, do the numbers work? We need to know what the returns are. Now, there are many ways of expressing returns. One is simply, what is the rental income divided by the purchase price? Now, that's a very simple indicator, but it will give you a rough idea as to what this investment is returning. And by simple analogy, if you put $100,000 in the bank, and they pay you $6,000 in interest during the year, then effectively you will have earned 6%. So in that sense, if you spend $100,000 buying a property, you get $6,000 in rent. In that sense, your returns are 6%. Of course, real estate is a bit more complex than that. And this is the very essence, John, of what puts most people off. They can't see beyond the subtle complexity here. Because even though the property may cost $100,000, remember, we don't necessarily have to put up $100,000. Maybe we got a $90,000 mortgage, so we're only putting up $10,000 cash. So then our $6,000 rental income divided by $10,000 cash put in looks like a 60% return. That looks a lot healthier. But of course, now we have to take account of the mortgage interest on that $90,000. And at 5%, that's going to be $4,500 a year. You have to deduct that from your $6,000. We're down to $1,500 divided by $10,000 cash going in, and we're now at 15% return. So you can see, John, we've jumped around from 6% to 60% down to 15%, and we haven't even begun to take account of things like property taxes, maintenance, homeowners association fees, pest control, lawn mowing, insurance, and nor have we taken account of other factors which may increase your rental income. For instance, there may be a laundry facility there, and that may generate another $600 a month. And another one, without getting too technical, the taxation benefits of real estate are so huge, they are so enormous, that for that reason alone, I think people should focus more on real estate. When you do some simple calculations, when you have your benchmark figures, such as what is your cash-on-cash return, how much cash is going in and how much cash is coming out after you've made all these expenses, then you start to get a handle on whether this would make a good financial investment or not. And certainly, once you've looked at 10 or so, you'll be able to rank them. You'll develop a sixth sense for what constitutes a good investment. And then once you've found the 3 or 4, maybe that weekend or that week that you think, well, these look pretty good, these seem to have a relatively high income for the area they're in, that's when you start to want to do slightly more serious calculations. You may want to take out a calculator, for instance, and start plugging in a few numbers. And you might want to jot down a few of these indicators. And then usually when people get more and more into the real estate investing game, they want to use some kind of software package to help them analyze it, because you know, we talk about rental income, but you've got to remember the vacancy rate. If there's a vacancy rate there, that's going to decrease your rental income. Similarly, if you engage a property manager, as we suggested a moment ago, they're going to charge for that. So the advantage of using some kind of a software package is that you will get a sense for what is happening and you'll be consistent. You'll apply those same factors, such as vacancy rate or property management fees, to each property.
It seems that to be successful in analyzing deals, we really have to know the language of real estate, understand terms like cash-on-cash return and positive cash flow and so forth. And you do have some guidance on this in the workbook. So, Dolph, what's an action step here?
Well, I think getting a rudimentary dictionary of real estate terms so that every time you come across something that sounds unfamiliar, you can look it up. There's nothing worse than spending a whole year not knowing the difference between equity and collateral. And I'm not suggesting I should explain it now, but we've already touched on some. Equity is what you own in the property. It is the total current value of the property, less any debt on it. And collateral is an asset that you use as security for a loan. So they're related terms, and my contention is that for electrical engineering there are thousands and thousands of terms and acronyms that one must learn in order to be a well-paid engineer. Whereas when it comes to real estate, there are only about 20 words that you need to know the meanings of. Equity and collateral are 2 of them. That only leaves us with 18. But know them you must, because if you don't know the difference, you can get caught out. And one of the secrets to being a great real estate investor is to just understanding those 20 or so terms better than the seller and better than your agent. Because if you know what they mean and they possibly don't, that puts you in a strong position. But if you don't know what they mean and you don't even know if they know what they mean, they could string you a line and have you believe anything.
We've talked about the numbers here and the calculation. Presumably, in most cases, you're going to go and actually look at the property. What do you look for? When you show up there and you're gazing around and you're wondering, is this the right thing for me to invest in? The numbers look right as far as the calculations you've done. How about the physical appearance and quality of the property itself?
John, I am usually amused and sometimes even astounded at what people think they look for. They go and look at these properties, and they'll do things like flush all the lavatories to make sure they actually work. And for the life of me, I can't understand why they do that, because what if one didn't work? Would they not do the deal? In fact, I quite like it when everything doesn't work, because it's put all my competitors off. They say, well, that's not a very good deal. The hot water tap doesn't work in the 3rd bathroom or something like that. Usually these things are pretty easy to fix. I personally do not feel I am sufficiently qualified to see whether the piles are rotting or whether the roof is leaking. So one thing I recommend, and certainly when you're starting out, is get a home inspector along to see if the house really is good. What I look for, more than the condition of the house, is what is the suburb like? What is the neighborhood like? Does it look as though it's inhabited by gun-toting, drug-dealing hoods? Or is it a nice family-oriented neighborhood where I would be happy to have tenants live? And I think that is a more important thing. You'll get a sense as to whether a neighborhood is in decline or whether it's up and coming. And if it's in a great neighborhood, which you can sense by driving around, you might park your car there and just observe things for 20 minutes. I think that is as valuable as trying to do the home inspection yourself.
We're talking here, Dolph, about looking for properties, and we're going to find the help of real estate agents in the neighborhood we're searching. Of course, there's probably going to be several real estate agents operating. I'm wondering, how are we going to choose which ones we want to really work with?
Well, there's another interesting point. Most people will choose a real estate agent seemingly at random. And I think there should be some kind of an interview process where you want to get a sense that this person is batting for you and has your interest at heart. As an investor, one of the things I insist on is that they are familiar with investment terms. I want them to understand what a cash-on-cash return is and some of those other factors that we discuss in the workbook. So what I suggest you do is you get a business card printed with your name, but then underneath in larger letters, because it's not about you, it's about what you do, you have your title, Real Estate Investor. This does 2 things. It lets everyone to whom you give such a card know that you're serious about investing. And secondly, and perhaps equally importantly, it also lets your subconscious know that you really are a real estate investor. And you know what, John, the interesting thing about this exercise is you can do this before you've even bought your first property, because your subconscious doesn't know the difference. If you're continually handing out cards, your name, real estate investor, then you're going to end up thinking, I really am a real estate investor. And that of itself will help you do your first or next deal. Because even Donald Trump says that there's a lot that we don't know about ourselves. And part of the fun of being in real estate is you can push limits and find out about yourself and find out what you're good at.
So We've been looking at properties, and let's say we've found the property that in the right neighborhood, with the right numbers, and it feels like this piece of real estate meets our criteria. We want to put in an offer. What do we do?
Well, it depends on whether you've been going through a real estate agent or not. Let's assume, because most people will do so, let's assume we've been going through a real estate agent. At that stage, you ask the real estate agent to draw up a contract. Usually it's called something like a contract for the sale and purchase of real estate, wherein you submit that offer. Now, you've got to figure out a number of things. One of the things you have to figure out is what is the price that you want to offer. For instance, they might be asking $368,000, but there's no reason why you have to offer $368,000. In fact, you could offer anything below that. You could offer more as well, and I know it often happens in a very hot market that people offer more than the asking price. So you have to figure out what is the offer price, and that will be part of your analysis. You'll come up with a figure that says, well, I can make this deal work at $340,000, but at $368,000 there's just not enough in it for me. So you then draw that price into the offer, you write that price into the offer. There might be some other conditions you want to put in there, and we won't go into them now, but in the workbook I've got some suggested clauses as to what you might want to put in there to cover yourself. If, for instance, you find out that there are aspects to that property that you don't like, you want to be able to get out of it. You don't want to be committed to buying it just because you've submitted an offer.
So you're not just going to leave it to the real estate agent to create the language of this. You're going to check it and maybe add some clauses or delete some clauses according to the guidance we're going to create in the workbook here.
Right, or at the very least, people can use this guidance to check in with their agent to make sure that they've covered this contingency, or to make sure that there's an out, or to make sure that there's a clause in there which makes the whole contract subject to finance suitable to the purchaser. Because if you just have that this contract is subject to finance and you end up saying, well, look, I couldn't find finance, the seller may say, well, I'll give you 100% financing at 63% interest per month. And you say, well, I'm not interested in that. And he says, well, tough. You said subject to finance and you've now got it. So you've just got to be careful to cover yourself like that. But once you've done that, you then have to just wait for the offer to be submitted to the seller. Now, another thing you might want to do on this offer is put in a time limit. For instance, you might say, this offer is only valid until 5 p.m. on, and you specify a date. It might be that day or 3 days later. You're putting a bit of pressure on. But, John, here's a tip that I've used again and again, and it is so effective that I can't for the life of me understand why more people don't do it, and it goes as follows. When you submit your offer, staple a check for the down payment or the deposit onto the contract. Now, when you think about it, it does not change the legality of that offer at all. By that I mean, if they decline your offer, they cannot bank your check. And conversely, if they accept the offer, you would have had to have written the check out anyway, so why not pre-write it, write it then, and staple it to the contract? Because I'm telling you, when you present a seller with an offer and there is a check stapled to it, suddenly he thinks, this person really is serious. In fact, if I countersign, so the seller thinks, I can bank the check. Of course, he personally can't bank it. It might go into the escrow account or the title company account if it's in the States, or it might go through a conveyancing solicitor if it's outside of the States. But nonetheless, psychologically, they know that by countersigning, by accepting the offer, they get access to that money. And that's why I say real estate is as much as anything a psychological game. Every aspect of it involves how people react. It's how we as humans react to these very bricks and mortar things out there.
It seems when it comes to writing an offer, there really are a lot of options.
Your creativity can run rife. You might have an out clause on the basis of finance. You can't get finance for it. You might have an out clause on the basis of the inspection. This contract is subject to the purchaser's approval of the inspection report. Or if, for instance, the land may have had some use on it which could potentially have contaminated the land, you could then say, this contract is subject to the purchaser's approval of an EPA, an Environmental Protection Agency report, or any other kind of environmental report. The other thing that you can use those out clauses for, though, is you might have put an offer in at $500,000 subject to an environmental report. and the environmental report comes back and says, well, it's pretty good, but it does need some cleaning up, and that cleanup is going to cost $40,000. You are now no longer committed to buying this property, but there's nothing to stop you going back to the seller and saying, look, I have here an environmental report. They say it's going to be $40,000 to clean up. I don't know if I want to take on that work anymore. I tell you what, I will still buy it, but you're going to have to knock $70,000 off the price. And then the seller, in turn, has the option of saying yes or no to that.
So the offer process doesn't really necessarily end with that first submission of the offer. There might be an exchange of paper between you and the seller. And this negotiation, just to get clear here, in the United States, I imagine in most places, happens through an exchange of paper. It isn't a face-to-face haggling.
Correct. Usually it's done in writing, and that's safest because no one can dispute what was written. We may, of course, dispute the interpretation of what's written, but usually when it's in black and white, there's no dispute. But having said that, depending on the deal, there's nothing wrong with you meeting face-to-face with the seller. In fact, I've often done that, even when agents are involved. I know some people balk at this, but firstly, I will never cut an agent out of a deal. If there's an agent involved, I'd say, listen, Fred, or whatever his name is, I'd really like to understand what the seller's needs are better. Would you mind if I had a chat with him and I just reassure the agent that I will not be cutting him out? And then I go to the seller and I say, look, you're obviously desirous of selling. I want to buy this property. I just want to figure out what your needs are. Maybe we can find a match. And it could be that his needs are totally different. For instance, he does need to sell. Price isn't that important, but he needs to have possession of that property at least until the end of August because he's got a big trade show on and he needs the premises for that. Well, if you can accommodate that, you might get a great price because he's going to make $100,000 from that trade show. So you can say, all right, well, let's settle or close after you need it, but we'll make the price suitably lower. It just depends on what their needs are. But by not discussing them, by not finding out, you'll never be able to do a good, sharp deal.
So you really look for a win-win situation in those conversations.
That's right. And that is why, these deals, they're not mechanical. That's why one of Donald's original books was The Art of the Deal. It is an art. It is not a science. And you've got to learn the nuances of talking with people and really relating with them, not just talking at them, but listening and finding out what are their needs.
Okay. We've explored the process of making an offer. So give us action steps. Apart, of course, there's the action step of actually submitting the offer, but what are some preparatory action steps that lead towards that point?
Well, to get a sense for what it's like, get hold of an offer contract, the contract for the sale and purchase of real estate, and fill it out. Make a dummy run. Get a sense of what it feels like. Then when you get to do an actual offer, it won't feel so bad. Now, if you want to be really daring, why not find a property this week that you think is the most likely candidate to be a great investment, and then figure out what price you would be willing to pay for it. You might think, look, at $200,000, I'm just not sure, so I'm not going to put in an offer. And I would say, okay, would you buy it for $30,000? And you might say, $30,000? Of course I would. I can do that with my eyes shut. I'd say, okay, well, how about $50,000? Find out what the price is that might just get the deal, and then write up an offer and submit it. The worst they can do when you put in a lowball offer is say no. Actually, that's not the worst. They can probably bop you over the head with an umbrella or something, but, they're not going to do anything worse than that. But at least it will give you a feel for what it's like submitting an offer. And by the way, if you're going to be in real estate, you have to get used to the word no. No is not a bad thing. It is just a successful way of not doing a deal, and you have to fine-tune how you do the deal.
Well, let's say the offer has been accepted. This is very exciting. The deal is going ahead. But there's a question of finance.
Right. Because we've said this offer is subject to finance. That is usually a clause in there. Well, I often say that finance is the most important aspect of acquiring real estate. In fact, for every day that you spend looking at real estate, you might need to spend a week arranging finance. Now, that has probably changed a bit, John, because over the years, finance has become easier to arrange. For instance, when I was a young lad, going to the bank to apply for a mortgage was this onerous task that just about every family feared. You were made to feel as though you should be honored even to be able to ask for a loan. Whereas these days things have changed. People realize that money is a commodity. There are not just banks offering finance, there are mortgage brokers, there are money originators, mortgage originators, financial institutions, insurance companies are offering mortgages. There are so many different sources of finance now, and they've really gone overboard in encouraging you to apply. As I said before, they have mobile managers who will visit you at your home or at your work. They will visit you on weekends and after hours. So it's become a commodity. Finance is relatively easy to get. However, the trickier the deal, the more important it is still to make a case to the institution, the bank or financial institution, that this is a good deal. And one of the things that I really think should be highlighted is that the bank is the mortgagee. They accept a mortgage, and you, the property purchaser, you are the mortgagor. This is how it works. You want to buy real estate, but do not have the money. So you go to the bank and you essentially say, listen, Mr. Bank Manager, you've got lots of money and don't want to buy the real estate. I want the real estate but don't have the money. If you will please lend me the money I need to buy this property, I will give you a written pledge wherein I faithfully promise to pay the mortgage interest and to repay the principal. So the bank gives you the money and you give the bank a pledge. That pledge is called the mortgage. That's why you are the mortgagor and the bank is the mortgagee. Now, the reason why I highlight this and the reason why it is so important is that many people make the mistake of going to the bank with the psychology of asking, even begging for a mortgage. And you should not do that. You should go to the bank offering them a mortgage, saying, Mr. Bank Manager, I have here a hot deal. Look at the return I'm going to get. I will so readily be able to pay for the mortgage, you'd be a fool not to give me the money. And by the way, if you decide not to lend me the money, there are 18 banks down the road that I'm going to go to. And in fact, you should do that. Now, another thing that I recommend is that people should draw up a small proposal for finance. Go beyond just filling out the standard bank application form, because don't forget, you've got to think of the psychology of the bank manager. He sits in his office day in, day out, getting a succession of people handing over their mortgage application. If in amongst those dozens of applications he comes across your proposal for finance, which has a nice color photo on the front page of the property you want to buy, and a summary, maybe a 3-line summary, where you say a mortgage is offered of $95,000 to be secured against a property located at such and such an address, representing 80% of the purchase price of $150,000 and X% of the registered appraisal of Y dollars, I mean, he's going to think, wow, firstly, this person's offering me something, not asking for something. That's significant. And secondly, he's going to think this person knows exactly what he's doing.
So once again, it's a question of psychology as much as numbers.
Exactly.
Okay, so now we've got the deal, we've got the finance, we're ready to close. Are there any issues for us to look out for at this point? In fact, how do we understand this process of the closing of the deal?
Well, all I'll say really is that some people advocate that you can save some money by doing the closing yourself. And I would say that that is foolish advice, because we can't be experts at everything. I recommend that people become experts at acquiring real estate and leaving the inspection of properties and the arranging of finance and indeed the closing to people who are professionals in those areas. In the United States, that is usually handled by title companies. In other parts of the world, typically that's handled by conveyancing solicitors. They handle the conveyancing of the property from the seller to the buyer.
Is there an action step here that can help us get a handle on the closing aspect?
Well, yes, don't wait until the day that you're supposed to close to find your conveyancing solicitor or your title company. Start doing some research. Try and get references. Often, again, a good source is the local Real Estate Investors Association. Find out which people and which organizations do a good job, and then talk with them and ask them to tell you why you should use them when you do have a deal. And again, you might eliminate some people that you, for whatever reason, don't like, and end up with a couple of title companies that you think will look after your needs and interests very well.
Excellent. Well, now we've closed, and we have the property, and it's going to need to be managed. Is this something we're going to do ourselves? Is it something we have to get somebody else to do? Help me understand that part of the process.
Well, let's fast forward a bit and imagine we now own 50 houses. My contention to you would be that it would be foolish to manage all yourself, because I'm telling you, managing 50 homes is a full-time job, probably for 2 or 3 people. So if it's foolish to manage 50 properties, would it be foolish to manage one? And my answer is, well, no, not initially, because you will learn the ropes. You will learn what it takes to manage a property, so that when it comes time to take on a property management firm to look after your portfolio for you, you will know which sorts of questions to ask them. So I think it pays to find out how to learn the ropes, find out what it takes to attract a tenant to a property, and then ask, if this property became vacant, how would you go about finding a tenant? And then once you've learnt those things, you can hand them on to a property management company. Now, of course, if you do them well, you might be able to teach them a thing or two, because, for instance, let's talk about finding a tenant in the first place. Most people will run an ad, again on Wednesday night's paper and maybe Saturday morning's paper, and hope that someone rings who ends up renting that property. I don't have the patience to wait that long, and perhaps I have the time patience. I just don't want to miss out on revenue for that long. So I've developed 21 other mechanisms of attracting tenants to a property. And one of them is very simple. It's so simple it seems obvious, with the benefit of hindsight, is why not go up and down the street and knock on every door, and you don't even have to own up to the fact that you own that property. You might just say, look, I'm looking after that property, or I manage it. And say, I manage the property down the road there. It's vacant at the moment. Before I advertise for a tenant, I just wanted to see if anyone living in the street had friends or relatives coming to town, and whether or not you wanted them to live near you. And John, you'd be surprised at the number of people who will grasp your hand and say, yes, my sister's coming to town. I would love for her to live in the same street. Look, don't rent it to anyone else. She's coming on Wednesday. Will you hold it for Wednesday? They get all enthused. That's just one of these 21 ways of finding a tenant. You can print flyers. If there's a nursing home nearby, ask if you may put a notice on their notice board saying, we specialize in renting to nurses. Here's the property for sale with details. Now, of course, do you really have to specialize in renting to nurses? And the answer is yes. You don't want to say anything that's even got a hint of being false. You do want to specialize in renting to nurses. Firstly, there's this nursing establishment there, and secondly, they make great tenants.
How about vetting the tenants, or the would-be tenants, because you don't want just anybody in that property?
That is true. I mean, ideally, we want someone who's going to stay for a long time, who's got great credit, doesn't do drugs in that house, who doesn't deal in guns and all that sort of thing. So it can be challenging to vet them, but after a while you build up a bit of intuition. You get an intuitive sense as to how people operate, and you start to know the sorts of questions to ask. One thing I'd recommend is do ask for references, and ask how long they were in the previous home. That's a pretty innocuous question. But if they've been in the previous home for 3 months and the one before that for 5 months, that's not as good as someone who says, well, I lived in the last one for 7 years. And then if they give references, make sure you call on them.
When we've got a tenant, we're going to set a rent, which is calculated according to the local market and what feels reasonable. But life changes and markets change, and it may be that in the surrounding area rents are rising. Is it difficult to raise rents? Is that an issue that we need to be aware of in this process?
Well, surprisingly, the biggest mistake that people make when they manage their own properties is they fail to maintain the rents at market levels. That is a big issue, and part of the problem, again, I almost am reluctant to bring it up, but it has to do with the psychology. They've gotten to know the tenant. They go round there once or twice a week collecting the rent. They've ended up on a first name basis, and the names of all their kids and their pets, and where they had their vacations, and what do they have in common. And they know that market rents are now $1,400, and this couple moved in when it was only $1,100, but they're so friendly, they just feel reluctant to raise the rent. And of course, if you like them enough to not raise the rent, that's one thing, but it's costing you. If real estate is your business, then it's costing you. And that is another reason why sometimes it's easier to have a property managed by a property management company, because they're more impartial. They don't have this personal relationship. And that is why when it comes to managing your own properties, I always recommend that people are firm but fair and friendly but not too familiar. Because if you get too familiar, then indeed it does become hard to raise the rents. So what I think a landlord should do every year, once a year, is do a phone around, either with other landlords or phone around a couple of property management companies and just ask, what are market rentals currently for a 4-bedroom, 3-bathroom home with a swimming pool in this suburb? And if your rents are way out of whack, if they're way below what they should be, it is time to do a review.
Now, with property management, what are the steps that we can take to prepare ourselves for that phase of the real estate adventure?
Well, about the only thing we can prepare ourselves for is starting to vet property managers. Because in all fairness, I don't think it's fair to run an ad in the paper looking for tenants and interviewing them even though you have no property to fit them in on the basis that you're just practicing your interviewing technique. But, you learn pretty fast. So when you do have real estate with vacancies and you start to advertise, you'll quickly learn the ropes. You'll quickly learn what works and what doesn't. So the action step that I would suggest there is, again, approach a number of property managers, say that you're a real estate investor. When you find properties that you'll want managed, why should you use them? And then stop talking. Because there's an old saying, as long as you're talking, you don't learn a thing. Of course, that applies to me right now too. And it's also true right now. But, you've got to give the other person a chance to pitch you or to pitch to you why they should be your property managers.
Well, let's talk about the business. We've got a tenant, we've got the property, we've got an income going. This is working. It feels like this could be the beginning of building real wealth. Now, you mentioned the increase in equity in the property that is likely to accumulate over the years, because generally we see that real estate grows in value. Not 100% certain, but that tends to be the pattern. But in order to get that equity out, am I going to have to sell the property and forego my passive income from the rents?
Well, no, and I make a strong case why selling is absolutely the worst thing one could do. Often I'll ask a large group, give me one advantage of selling. And to this day, John, I have not had a rational reason why one should sell. Sometimes they might say, well, to cash in on your profit. But let's explore that just for a brief moment. Let's say we bought a property for $100,000 and it's now worth $200,000. In other words, we've made $100,000 profit. If we sell that property at $200,000, then we're going to pay commission, and at 6%, it's not 6% of our profit, it's 6% of the sale price, or 6% of $200,000, which is $12,000. So instead of getting $100,000, we're going to get $12,000 removed from that. We're down to $88,000. Then we may have to pay capital gains tax. But let's say they only take out $20,000 in capital gains tax. We're now down to $68,000. If you've done any depreciating, then you're going to have to pay what's called depreciation recapture tax. We might be down to $65,000 that you get when you sell your property, which you thought had $100,000 profit. So here's the other scenario, the alternative. You buy a property for $100,000, it goes up in value to $200,000. Let's now refinance. Let's go back to the bank and borrow more money. If we got a modest 90% mortgage on that property, and by modest I mean that you can get more than 90%, you can get 95%, you can get 100%, believe it or not, and I'm sure this will astound some people, you can at the moment get 125% mortgages in this country. So 90% is modest. If we got a 90% mortgage on that property, that would be $180,000, or $80,000 of that $100,000 profit that we could get, as opposed to perhaps $65,000 if we were to sell. So we've got more cash than if we'd sold. Admittedly, we now have a mortgage of $180,000 on which we have to pay mortgage interest, but on the other hand, we still have the asset worth $200,000 generating income. So we are far better off by not selling and refinancing. We still own the asset. There's no tax on that $80,000. You can do with that money as you see fit. You can have a holiday with it. And what's more, if you use that $80,000 to buy more investment property, then the mortgage interest is tax deductible. There are so many compelling reasons why selling will always be regretted and why hanging on to it will be one of your best moves, that I strongly encourage people to think twice before selling. Now, to be sure, John, there are extenuating circumstances under which it makes sense to sell. I confess to having sold 4 properties in my life, but all the other properties I've bought, all the ones you might read about in my books, I still own them. They still generate income, they still go up in value.
So if we pull back here and look at the big picture that you're describing, tell me if this is right. We're looking at 90 days to begin with, and probably more than that, of effort and learning, of activity that's going to consume our time, but maybe very interesting. It's not all going to be tough and hard. Some of it may be a little scary, and some of it may be quite intriguing. The picture I'm getting is that over time, there's going to be an increase in return and a decrease in demand on our time and our effort as we become more expert and knowledgeable, and also as we acquire more assets.
That is absolutely right. And you say it might involve a bit of work at the front end. Look, that is true. I have owned up to the fact that it will require quite a bit of work looking through deals to find a few that might work for you. But think of it this way. There's no such thing as a free lunch, as they say. So sure, you have to put in some effort. But when you acquire even just one property a year, within 10 years you can be financially free. And that is something that I think few other professions or financial endeavors can claim. When you buy in a city that has average growth, you are going to do reasonably well. Which really does bring me to another point, John, and that is in any other endeavor, in any other investment avenue, how would you beat the average? My contention is that it is impossible to know how to beat it. How would you beat the average in stocks? 5 years ago, everyone was saying you beat the average in the stock market by buying technology stock. And we all know what happened there. Whereas it is my contention that you can beat the average in real estate. And you can beat the average in real estate because the market trends are much slower. So the average growth rate in the United States, for instance, last year was 9.7%. That's on average. Now, there are areas that did a lot worse than average and areas that did a lot better than average. And the ones that did better than average, for instance, the top two cities in this country, Las Vegas, Nevada, and Phoenix, Arizona, they've been in that position for 11 and 8 years respectively. In other words, it is a pretty safe bet that this year Las Vegas and Phoenix will do better than average. Would I bet my life on it? Probably not my life, but I bet my own money on it, and that is why you will see me investing heavily in those cities, because the growth is so incredible there. It is so phenomenal that I'm confident I'll do better than average.
Well, Dolph, to end with, are there any words of final advice or encouragement that you would give to the listener who's embarking on this adventure of real estate investment?
Well, a number of things come to mind, John. And firstly, I know through having taught a lot of people that there's this fear that comes up. We get scared because we're signing up for a property that might be worth $200,000, and this fear comes up. What if it all goes wrong? What if the economy tanks? What if mortgage rates go to 20%, as indeed they have been in the past? So a saying comes to mind that really sums up the attitude I would encourage people to have, and that is that courage does not mean having no fear. Courage means acting despite your fear. And John, the second thing is, it sounds almost like a contradiction in terms, but I firmly believe that the deal of the decade comes along about once a week. Now, if you believe that the deal of the decade, by definition, has to come along exactly every 10 years, then when you hear that I have done a good deal, or anyone else for that matter, you'll stop looking for the next 9.9 years because that decade's deal is gone. However, if, like me, you believe that the deal of the decade comes along about once a week, you will look all the time. And it's a funny thing, some people are so convinced that a deal that sounds too good to be true is too good to be true, that even when someone delivers them this spectacular deal on a silver platter, because it's good, they will dismiss it as saying, no, I smell a rat, there's something wrong here. Now, I'm not saying that every deal that sounds too good to be true, you should accept it as gospel or anything. Of course not. But in amongst every 20 or 30 deals that do sound outrageously good, there will be one gem that genuinely is. So the trick is to have an open mind, to just be accepting of the possibility that this could genuinely be a good deal, that someone is selling it at a ridiculously low price because they simply don't know the true value. These things happen when you have that attitude, when your curiosity is on full beam. When you go to bed with a clear conscience and a happy heart, when you wake up in the morning saying, I can't wait to get out there because I know there's a hot deal out there somewhere. One of my favorite sayings, which really sums up my attitude to life, is that I don't whistle because I'm happy. I'm happy because I whistle. And as long as you whistle enough in life or in this real estate game, you will end up being happy as long as you have faith that there are great deals out there, that there are tenants who want to look after your property reasonably well, because for them a rental property is just a stepping stone to acquiring their own property. As long as you have faith that there are property managers out there who want to do well by you as well, then you will surround yourself ultimately with like-minded people, and eventually things will come right. And then you'll be sitting on a yacht or lying on a beach or reading a book at home, knowing that you could go out and work, and you might choose to do that. But even if you didn't, you've still got income coming in, because people, they might not be happy about the fact that they're paying you rent, but at least they'll acknowledge that if they weren't paying you rent, they'd be paying rent to someone else. So they are very accepting of that. We've got a win-win situation.
And does this suggest a final action step?
Well, I think one of the most important things that you have to do when it comes to trying to build wealth is you've got to remember that we're only on this planet for a relatively short time. In fact, one could say we're going to be dead for a mighty long time. So we have to make every moment count. And too many people, I think, are so focused on earning money that they forget and lose track of why they want money. They want money to have a lifestyle. They want money to be able to travel where they want to go and do the things they want to do. So you don't want to work hard for the first 70 years of your life so that when you're in a wheelchair and you have all kinds of contraptions to help you see and hear and eat, that you try and spend your money. The trick is to try and enjoy the journey. It's to have fun on the way. And that is why I always say, if you can't put your head down on your pillow at night and say, wow, today was fun and I'm looking forward to tomorrow, if you can't do that, you're doing something wrong. You've got to change what you're doing. So remember to have fun. It is why we are here.
As Donald Trump says, love what you do.
That's so true.
Dolf de Roos, thank you very much.
So welcome. It's a pleasure. Things that they did have in common. And one is that almost without exception, the rich either made their money or held their wealth in real estate. And that is why at the tender age of 17, I decided to get into real estate. To this day, I've never had a job, and I've just been in real estate ever since.
What is it about real estate that you see as so specially powerful and valuable?
John, I believe that real estate is the only investment vehicle that in fact will give you true passive income, and I've got some very strong views on that. But before getting into those, I am astounded that something like 93% of Americans, when they invest, or when they think they're investing, they invest in the stock market. And I think the stock market is almost the very opposite of what real estate offers in terms of benefits. And let me give you some brief examples. If you wanted to invest in either the stock market or real estate, and let's say you've got a lump of money, it doesn't matter how much, it could be $1,000, it could be $1 million, but let's talk about $100,000. When you invest $100,000 in the stock market, you can buy exactly $100,000 of stock. That's the way it works.
Dolf de Roos was born in New Zealand, speaks 6 languages, and is a highly successful real estate investor, both inside and outside the United States. Dolf has written 5 real estate books, including the New York Times bestseller Real Estate Riches. He's also introduced a powerful software program for analyzing and managing investment properties. In the late 1990s, he launched his own property investment company, and today its holdings range from high-rise apartment buildings to high-end vineyards. Dolf is frequently asked to address investors' conferences and to make radio and TV appearances. Nevertheless, his primary focus remains to this day the real-world business of real estate investment. Dolf de Roos, we've invited you to contribute the segment on real estate investment to the Wealth Builders Blueprint because of your experience as a real estate investor and as a teacher to thousands of others worldwide. Tell us first, please, a little bit about your experience with real estate as a practitioner and as a teacher.
Well, John, I had an unusual introduction to real estate. I came from a family who believed that to do well in life, to do well financially in life, you have to study hard and get a degree. So it was without thinking when I finished high school that I went to university. And it was during my very first week at university that I looked around me at the people with the degrees, the professors, the tutors, the lecturers, and they seemed anything but rich. So I thought there's something wrong with this theory that degrees equates to wealth. So I set about finding out what is it that the rich have in common. I thought if I could identify 30 or 40 things that the rich have in common, and if furthermore I could emulate those things, then I too could be rich. And at the time it seemed like a perfectly reasonable theory. So I started the study not realizing it would take more than 9 months because, John, I could hardly find anything that the rich had in common. It certainly wasn't age. By all accounts, Bill Gates was a young man when he made his first billion. It wasn't gender. It wasn't religion. It wasn't whether you were born into a rich family or not. It wasn't whether you were an immigrant family or not. And it certainly had nothing to do with education. So at the end of my 9-month study to find out what the rich have in common, I could only find 2 things, whereas that same $100,000 when invested in the real estate market can easily buy you $1 million of real estate. Now, to be sure, you need a $900,000 mortgage to do so, and I know some listeners might be saying, well, hang on a minute, with a $900,000 mortgage, how am I going to pay the interest? Well, the answer is, of course, you own an asset worth $1 million that is generating rental income. So the point is you've got leverage with real estate in a manner that you don't get leverage with any other investment. To put it another way, if you went to any bank manager anywhere on this planet and said, Mr. Bank Manager, I really believe that gold is about to go up in value. My neighbor believes in platinum and silver, and my auntie is a stamp collector, and my friends collect baseball cards, and I think I should get some antiques and paintings. Will you please lend me some money so that I can invest in these things? He will laugh you out of his office. Whereas anywhere in the world you can go to a bank and say, I want to buy some real estate, will you lend me some money? Not only will they say yes, they will be falling over themselves to give you that money. In fact, there are billboards, there are newspaper ads, radio ads, TV ads saying, thinking of buying real estate or thinking of refinancing? Come see us first. We'll give you the best deal. We have mobile mortgage managers. We will visit you at a time and place to suit you. They want to lend you money. So you've got leverage. The effect of that, of course, is that if everything goes up by 10%, your stock portfolio of 100,000 would have gone from 100,000 to 110. You've made 10%. Whereas your real estate would have gone from 1 million to 1.1 million, and you've made 100% on your investment. Secondly, when you spend $100,000 buying stock, how many dollars worth do you have? What's the value of that portfolio? And the answer is it's worth exactly 100,000. We'll ignore commissions for a moment. Because the stock market is very efficient. It doesn't matter whether you're in Los Angeles, New York, in Guam, Peru, Helsinki, wherever. If you want to buy a particular stock, you will pay the same price as anyone else. Compare that with real estate. You've spent your $100,000 cash buying a property for a contract price of $1 million using a $900,000 mortgage. The day you buy that property, what is it worth? And a lot of people say, well, it must be worth $1 million. And indeed it could be. However, is it not possible that some fast-talking seller talked you into paying too much for it and it's only worth $650,000?